Welcome back everyone to the channel, encouraging you to earn more, spend less, and invest the difference. Now hopefully all you guys know that tax season this year has been extended due to the coronavirus, so you have all the way up until July 15th of this year in order to file your taxes. But when it comes time for tax season, a lot of people get nervous about taxes, the IRS, and being audited. They think that the IRS is like the boogeyman that's just out to get them. But thankfully for most people, that's simply not the case. For the overwhelming majority of people watching this video, your chances of being audited are extraordinarily low. Now, a few decades ago, the IRS was conducting a lot more audits, and so at the time, your chance of being audited was roughly about 1 in 90. But now due to funding problems, the IRS is only auditing, on average, about 1 out of every 170 individuals. But that doesn't mean that you have a 1 in 170 chance of being audited, because it's going to vary dramatically based on 3 factors. One is going to be your income level. Number 2 is going to be the types of activities that are reported. And number 3 is just, does anything look out of the ordinary with your particular tax return? So let's break those 3 things down individually. So the first thing that's going to impact your overall chances of being audited is going to be your income level. Now, the IRS is not a business, but they do have a budget that they have to follow. So in order to maximize the money that they have been given by the government, they want to go out and target people that are realistically going to be worth their time in targeting. So for example, if they go out and they audit a billionaire like Mark Zuckerberg, and he makes a tiny error on his taxes, even if he didn't mean to, a tiny error on somebody like that's taxes, the IRS could recover potentially tens of millions of dollars. So they really want to target the high income earners. But if they go out and they target some Joe average guy who's working at Walmart as a cashier, and he only makes, let's say, $25,000 a year, even if this Joe made a major error on his taxes, what's the most that the government is going to recover out of this error? $100, $200? It's just not economically worth their time to actively go after the little guys. Now they do audit some people at the lower end of the tax bracket just to kind of keep people honest, but for the most part it's going to be a graduated system where the more money that you earn, the higher your chances are of being audited. So these are the actual IRS statistics from the IRS website for the most recent tax year that is reported. And so if you are making over $10 million per year, you have a 6.66% chance of being audited. But if you're on the lower side of this income level, let's say you make between $25,000 and $50,000 a year, you have less than a 0.5% chance of being audited. Now you will notice that people that earn 0 income actually have an increased chance of being audited at a little bit over 2%. This is because it's rare for people to make so little money and at the same time to have such high expenses to offset the entire amount of their income. But even if you fall under this really low category, from 25 to 50,000, and you have a 0.48% chance of being audited, there's going to be a lot of factors that go into that. So that doesn't mean that immediately you have a 1 in 200 chance of being audited. There's going to be other factors that go into that as well, which brings me to my next point of what types of activities are you engaging in. If all you're doing is filing a W-2 statement saying that yes, I work for my employer and this is how much they pay me, your chances of being audited are extremely low. But as soon as you start filing additional items such as a Schedule C, which is going to be your business income, then your chances of being audited go up. And this is because as a business owner, you have a lot of tax deductions that are available to you. And all of these tax deductions cause a situation where you are sort of incentivized to exaggerate the truth as far as what's an actual business expense or what was a personal expense. So as soon as you file a Schedule C as a small business owner, maybe you're a sole proprietor or you have an LLC or whatever the case may be, as soon as you file a Schedule C, your chances of being audited go up a little bit. So how much does filing a Schedule C and some of this other stuff affect your chances at being audited? Well, it's impossible to say, but the first thing you have to realize is that there's not somebody at the IRS individually sitting down and looking at each and every tax return. These are all automated computer algorithm sorting methods. So these algorithms are doing a first glance look through all of your stuff, and they're comparing your tax returns to the tax returns of other people that are in similar situations to you, and they're looking for any kind of items that stand out or are unrealistic. Now, just because something stands out doesn't mean that it's not legitimate. Just make sure that you have the proper documentation if the IRS questions any of your tactics. So a few common things that are kind of red flags for the IRS when they're doing this scanning of your tax returns is a few things. So in no particular order, they're going to be looking at cash businesses. So if you own, let's say, a bar or a hair salon or something like that, where you deal primarily with cash items, they're going to be scrutinizing that a little bit more to make sure that you actually have reported all of your income and that you're not secretly skimming some money off the top and only reporting a portion of your income. So they're going to look at ratios based on other people that own bars or salons and see if what your income level makes sense. Now, obviously, people dealing in a cash business have the opportunity to skim money off the top. But it could be that you simply have a second job and a second W-2 statement or a 1099s that you are not reporting. Now, whenever you get paid with your W-2 job, that's your normal job, or a 1099 as maybe an independent contractor or something like that, you get a copy of those forms, but whoever paid you that money also sends a copy of those documents directly to the IRS. So the IRS knows if you have a side hustle or something like that, if you drive for Uber or Lyft. Uber and Lyft has already reported your income to the IRS. And that means they already know about it. So if you don't report it to the IRS, they know that you are purposely withholding income, and that's going to obviously increase your chances of being audited. The next red flag is taking disproportionately large tax deductions. So let's say that you make $50,000 a year and you claim that you have donated $20,000 to charity. Now, it's possible that you're a philanthropist and that you have actually donated this much money, but it's unlikely. So this is going to throw a red flag, and the IRS is going to investigate this $20,000 contribution much more closely and make sure that it's actually legitimate and that you're not using this as some BS method of reducing your tax burden. But at the same time, if you made $1 million a year and you donated the same $20,000 to charity, that doesn't look quite so conspicuous. So your chances at that point are much lower than if you had only made $50,000 and contributed $20,000 to charity. And that can go for any type of deductions that you're claiming, not just charitable contributions. So let's just say that you sell t-shirts, you print them up and you sell them. And let's say that you have total sales for the year of $50,000, and you also claim a $50,000 deduction for items like materials and printing costs. Well, that seems pretty high. That means you literally made $0 of profit in your business. And so they're gonna look and see, are you reporting all of your sales, or are you skimming some off at the top? And are you accurately representing your expenses? Because obviously if you make $50,000 in sales and you have $50,000 in expenses, something doesn't quite add up. This is not a profitable business. Also, if you are claiming large rental property losses, that can trigger an extra level of scrutiny by the IRS. So with most real estate rental property losses, the majority of people can claim up to $25,000 of losses against their normal income, unless you are considered to be a real estate professional. And this is relatively hard to do if you own a few rental properties or something like that. You are not a real estate professional. But if you are a professional, you can write off significantly more money on your taxes. Another item that throws a red flag is if you are consistently losing money at your business. I mean, think about it. Businesses exist for the sole purpose of turning a profit. So while it's perfectly fine for some years to be bad for business and you lose some money, so you claim a total loss for the year on your taxes, that's fine for 1 year. But if it happens consistently, the IRS is going to scrutinize that. They're going to wonder how you are able to stay in business and why you have not gone bankrupt already. So generally speaking, the IRS wants you to be able to show profitability for 3 out of the last 5 years worth of tax returns. And another way that people take advantage of these businesses that lose money is they are claiming a hobby as a business. So if you own horses and you are a horse breeder, that's great, that's fine, that's a perfectly legitimate business. But you have to be breeding horses with the intent of turning a profit. So if you are just a small-time horse breeder and you sell 1 horse every 3 years, and so you make a few $1,000s off of that sale, but then you turn around and claim tens of thousands of dollars of loss for things like food, shelter, medical expenses, that kind of a thing. The IRS is going to say that you don't have a business of selling horses. You have a hobby. You just enjoy having horses around for your personal enjoyment, and that this is not a legitimate business. With a legitimate business, you have to have the intent of being able to generate a profit. Meals and entertainment is always a big one. So if you're out of town on a business trip, it's perfectly okay to be able to deduct some of those meals and travel expenses from your taxes if they're not somehow reimbursed by your employer. But make sure that you have substantiating documents for all of this stuff, especially if your costs are very high. So if you are a small-time business owner and you go and you travel and you stay at some 5-star luxury resort during your stay, they're going to look at that a lot more closely than if you had just stayed at the Super 8 or the Hilton or something a little bit more in line with your overall budget. Same thing goes with food expenses. Make sure that you are able to properly document and have all the receipts necessary if you're claiming any of these meal deductions while you're traveling. And so another huge red flag item is if you withdraw money from your retirement account that is not a qualified distribution. Let's say you take this out before you turn age 59 and a half. A lot of times this money is going to be subject to the normal tax rates, but it also incurs a 10% penalty for withdrawing this money early. And this is going to be a huge deal because according to a 2015 report done by the IRS, of all the people scrutinized, 40% of these people made errors when it came to their retirement payouts. So make sure that if you're taking money out early, that you're paying all of your taxes on this money, as well as any penalties that may be associated with this early withdrawal. But the good news is, if you are not engaging in any of these activities, and you don't have a Schedule C, and you don't make a ton of money, your chances of being audited are extraordinarily slim. So don't think of the IRS as the boogeyman that's out to get you. File your taxes with confidence. As long as you're accurately reporting your numbers, then you should have no problem when it comes to tax season. Now, if you found this information useful, consider subscribing, and as always, I'll see you all again next time. Thanks.